Hi, everyone, and welcome to this episode of Money Moves. Every episode, I go over the topics that are affecting the markets the most. And first up for this episode, Brexit talks seem to be reaching their final conclusion, and a potential no deal between the European Union and the UK seems like the most likely outcome. Next up, let's talk about Tesla joining the S&P 500 and what that potentially means for a lot of buy and hold investors and even traders who use the S&P 500 as their underlying vehicle for options. In the last news article for this episode, Facebook is facing new antitrust investigations, and let's talk about what the risk might be to Facebook. Then I will go over each of my investing accounts, starting with Worthy Bonds. Then I will go over my Fundrise account. Then I will go over my retirement account. Then I'll go over my M1 Retire account, as well as my higher yield savings account. Then I'll finish up my investments with my Robinhood portfolio and my Tastyworks portfolio. And to finish out the episode, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like owning the Bugatti Divo, or if you're just getting started on your financial journey, definitely like and subscribe. Only 40 Divos will be made for the entire world, and they sell for $8 million. Welcome to the Portfolio Bulletin. Let's get started. So Brexit is going past another deadline, while leaders pledge to go the extra mile. The European Commission President, Ursula von der Leyen, said her and Prime Minister Boris Johnson are responsible for going the extra mile at this point, as a no deal would be very detrimental to the European economy as well as the global economy. These leaders have been going at this for quite a few years at this point, and there's certainly concern that a no deal between the UK and the European Union, and if they don't come to that trade deal, there certainly will be some jobs lost in both the EU as well as the UK. The UK and the EU have agreed to keep the same standards and regulation through the end of the year, despite the UK leaving in January of this year. However, that transition period is almost complete, and if they have a no deal, it will push up taxes and costs for exporters on both sides. They mentioned that the negotiations here are particularly difficult because they are trying to break from the current set of rules and establish a new set of rules, which is not generally how trade deals happen. Trade deals generally harmonize food, labor, and other standards, but since they are trying to change the standard from what already exists, it seems to be more difficult. The main sticking points here are the fisheries, competition rules, and arbitrations over their potential new deal. By arbitrations, they mean if the rules are broken between the UK and the European Union, they have to go to the courts, and the European Union is concerned that if they have to go through the UK court system, that the rules will not be enforced in a timely manner, and therefore the rules won't be very useful because the UK can continue to break them potentially without this enforcement. The fisheries are also a pretty large concern. The UK doesn't want the European Union fishing in their territorial waters, which would definitely affect a large portion of the economy. I will quickly play a little clip of Boris Johnson talking about the discussions, just to give a little bit of context on where they stand currently.
Any at all centimetres, millimetres of political movement in the last few days?
Sam, we are always happy to talk and to make progress where we can. I do think, as I say, there is a deal to be done if our partners want to do it, but we remain very far apart on these key issues, and you know what they are. The UK can't be locked into the EU's regulatory orbit, and we've obviously got to take back control of our fisheries, 4.5 years after people voted for it.
If Boris Johnson's haircut is any indication of how this deal is going, it is certainly terrible. But on a real note, it seems like coming to a deal will be pretty difficult, and he has some genuine concerns that the EU will not compromise towards the sovereignty of the UK, which will certainly hurt both parties, as I mentioned before. Moving on to Tesla joining the S&P 500 and what it will mean for your investments. Tesla joins the S&P 500 at the beginning of next week on December 21st, and it will be the most valuable automaker in the world and the 8th largest stock on the index, meaning that its impacts will be quite large relative to a lot of other companies. There's around $5.4 trillion invested in index funds tracking the S&P 500 right now, including $620 billion in the Vanguard S&P 500 index and $322 billion in the Spider S&P 500, ticker symbol SPY. On December 21st, these funds will have to purchase tens of millions of shares of the stock and sell shares of another company in order to rebalance the portfolio. Current market capitalization is around $500 billion for Tesla, meaning that its estimated weight will be around 1.5%. This translates to around $81 billion going into Tesla shares, or around 17% of the stock's free float, which will be more than 3 times the average trading volume in November. They also mentioned that most index funds are able to begin buying Tesla ahead of the change and can continue to do so after the expected date, so this overall process could take months. This is certainly concerning because Tesla stock has surged 59% since the committee announced its addition, meaning Tesla is at all-time highs, and there's definitely some concerns about the valuation of Tesla and what it could potentially do into the future. If the stock is at all-time highs and we see a little bit of a retracement, or the stock simply comes down to earth in any reasonable way, it could drag down the overall index, which is also right around all-time highs. And most people think that the S&P 500 is already pretty overvalued based on future earnings, due mostly to speculation. This further adds to the fact that the S&P 500 is more top-heavy than it has been in any other time in history, with the top 5 companies making up 23% of the overall index, and the top 10 companies make up 28%. And by the simple math, 490 companies make up the bottom 72%. Tesla stock has surged 667% year to date, and that growth rate is unlikely to continue, while Tesla bears continue to caution that the stock is way overvalued at 161 times earnings for next year. They also mentioned that Goldman Sachs surveyed 189 companies and found that 157 of them, managing around $500 billion in assets, don't own any Tesla shares as of September 30th. If some of these mutual fund companies start buying up some Tesla shares to keep up with the overall S&P 500 index, it could drive up the stock price a little bit more, as some of these other companies who have ignored Tesla up until now are forced to buy the stock. So overall, I think there is certainly some downside risk, and the expected diversity of purchasing the S&P 500 is slowly going away because each company is weighted based on its total market capitalization. And as I mentioned, those top 10 companies are making up the vast majority of the overall S&P 500 right now. And with Tesla's massive valuation and huge PE ratio right now, there is certainly some risk that Tesla could drag down the overall markets going into next year. And lastly, on the news for this episode, Facebook and Google are facing some antitrust risk. Congress is starting to crack down on the power of mega-cap internet companies, making its case against Google and Facebook. Analysts are already looking at the terminology used by the House Antitrust Panel, and while they used some harsh language, he found the case to be remarkably thin on violations of current law. The subcommittee recommendations were consistent with their legal scholars that suggest the U.S. move away from consumer welfare as a guiding principle of undergirding U.S. antitrust law. In basic English, this means they would be moving away from a lack of competition and pricing being the guiding principle and moving over to a more socio-political set of goals, meaning that if they don't like what the company is doing or if they don't like how it's purchasing its competition, they would move to utilize antitrust rules to break up that company. This is definitely pretty concerning if they can use this methodology, which means they could basically go after any large company that they don't like, which is what you read here when they talk about Alphabet, Facebook, Amazon, Apple, and Microsoft, some of the biggest companies in the world. And if they're not operating by how the House Antitrust Panel likes, then they could move to break up any of these companies for essentially any reason if they just don't like what they're doing. Instead of what it used to be, where if a company owned an entire industry and they could drive up the costs in order to protect the consumer, they would break up that company to provide a little bit of competition. But that's not what we're seeing here. And if the House moves on this, it could be hugely detrimental to the largest companies in the S&P 500, which ties back to what I just mentioned. Those companies make up a huge percentage of the overall S&P 500 and would hugely affect a large portion of U.S. investors with over $5 trillion in assets invested in the S&P 500 right now, which further means they own a large percentage of these companies. If they were to bring a case, it would take a long time to litigate, as most antitrust cases do take years to come to full fruition, but it's certainly a risk factor to companies like Google and Facebook, and to the rest of us who own the S&P 500 or trade it regularly. Moving on to my investments, starting with Worthy Pure Capital. I continue to withdraw this money, and I will withdraw the interest at the end of this month again. I don't sell any of the bonds that I own, but I do withdraw the interest regularly because I don't want to own too much more in bonds, as I already own a pretty substantial amount of bonds, and I also lump in Lending Club into this portfolio. So between Lending Club and Worthy Pure Capital and some government bonds and bond index funds in my retirement account, I'm a little bit overweight in bonds. If you're looking for a secure way to own bonds that yield 5%, there is a link in the description that gets you one free bond when you fund your account. Moving on to Fundrise, you can see this new tool is saying my account needs attention because they don't think I'm on track to my current goal of $500,000 by 2040. But let's take a look at what that actually means. They added this tool to Fundrise right before my last episode, and it shows where it thinks I am and where I'm going. And it says my midpoint here is at 526,000 and my high end is 745,000 and my current rate, and that I need to add $800 a month to stay on track for my $500,000 goal by 2040. I'm not sure why it thinks I need to add $800 a month if my midpoint is already above 500,000 and I continue to add money every month. So I think this tool is really just trying to get you to invest a little bit more money than you were planning to originally. So just keep that in mind if you're looking at this and you're a little concerned that you might not be reaching your goal with Fundrise. Moving on to my performance, you can see these operating REITs, the Growth REIT and East Coast REIT, are performing well. Moving up towards the end of the year here, the Washington, D.C. REIT, as well as the National E-Fund, were combined into the Fundrise E-Fund, which is also doing quite well. And then moving on to these funds that were recently generated and are currently ramping up, they did not return very well except for the Growth REIT 3, which did do pretty well at just over 7%. But a lot of these funds returned no equity, which is dragging down my overall performance at 4%. That's because these are long-term investments, and I do expect this overall annual return to go up with time as these funds become more and more active and start generating returns. Moving on to my retirement account, which is split up between a Roth IRA and a 401k. These are self-managed, but they are completely invested in index funds. And you can see my current account distribution is 26.5% total stock market fund, 39% S&P 500. The F fund is a total bond index fund, and the G fund is government bonds. And then the Life Cycle 2050 fund, which is currently just over 10% G fund, 8% F fund, 40% S&P 500, 12% total stock market fund, and 28% international stocks. And this fund doesn't do particularly well, which is why I don't own it outside of this life cycle fund. And this adjusts every quarter to supposedly reduce my overall risk. Looking here, you can see my transactions for December. $292 is my employer matching, and this goes into my 401k, which is required. I'm not allowed to put my matching funds into my IRA because these are pre-tax dollars, and if I put pre-tax dollars into an IRA, then they would be untaxed completely, so they don't allow you to do that. And then over here, I have my personal contributions, which go into my IRA. Moving on to my M1 Retire account, which has done pretty well over the last month at 3.77%. Been fairly flat for the last couple of weeks, as the market has been pretty flat overall. Moving on to my holdings here, you can see just about everything is up except for utilities, which has been pretty choppy. And you can see all of these funds are down overall for the last month. Looking at activity here, I continue to receive dividends from companies like Visa, Pfizer, Aflac, Microsoft, Johnson & Johnson, Target, and Costco. And I did make some stock moves here. I'm selling FTAI, Amogen, Lockheed, and General Dynamics. These companies have been struggling quite a bit, and I wanted to move that money into some better performing stocks that I think have a little bit more potential. And you can see here, Global Payments is going to get the most money. Companies like Boeing, AbbVie, Waste Management, Johnson & Johnson, I think have better potential, and this money will be invested based on my percentages. Moving on to my higher yield savings account, you can see it's up 1.25% this month. This is well over the annual percentage of most high-yield savings accounts right now, which is why I don't advocate putting too much money in those savings accounts because the rates are so poor, and you can get better rates even if you just invest in a bond index fund, which is much more stable, and you receive those dividends at a higher percentage than you will receive from a high-yield savings account. Looking at the funds here for the past month, Realty Income Corp continues to struggle, which is a little bit strange. This is a pretty strong company, and it didn't drop quite as much as some of the other real estate investment trusts, and maybe that's why it's not recovering quite as well. They continue to pay their dividend and increase their dividends every single month, so I'm going to continue to keep this a pretty large holding here at around 11% of this portfolio. Otherwise, everything else is doing well. Even VIG continues to do well. Even the bond funds are up quite a bit over the past month. And then all of the value funds continue to do well also, as we have seen that value rotation over the past month and a half or so. Moving on to my Robinhood portfolio, you can see over the past month, we're right around that 12% mark, which is very good. I do have quite a bit of money at risk right now at just over $8,600, which really is the majority of this account. I do have quite a bit of buying power still available here, but most of this is margin. And I do have positions here in Apple, AMD, Kodak, Lululemon being probably the most difficult position right now because it was down quite a bit after earnings, Palantir, and Starbucks. If you want to know more about these positions, definitely like and subscribe for my overall options portfolio reviews, where I go into more depth about these positions and how I trade options. Moving on to my Tastyworks account, you can see the markets are open here on Monday. I did add a couple of positions this last week, like Jumia and Neo. These are some pretty growth stocks, and they have high volatility, just like Palantir, which is also doing very well. And then I added Snow here, which is down pretty well off of its highs of around $380 per share. But overall, this portfolio is still doing quite well. Taking a look at my biweekly tracker for this episode, you can see my cash is still pretty stable here, maybe a little bit high just above that $10,000 mark. And I do need to invest some money going into next week. Stocks continue to uptrend. You can see my trading accounts continue to uptrend. Again, this is just market growth here. Bonds continue to stay flat. I will decrease this here into the future. REITs continue to increase, which is what I want. And then Lending Club continues to downtrend as we get closer and closer to Lending Club ending its retail investing side. Also pretty cool, I broke past that $200,000 mark here of total invested money. So just to summarize, Brexit is looking a little bit rough and it might affect the global economy. There is certainly some downside risk that I think is generally being ignored because it's overshadowed by the Rona and vaccine talks, as well as stimulus talks. Tesla is joining the S&P 500, and a lot of people are going to own quite a bit of Tesla, and the S&P 500 is becoming overly concentrated in the top 10 companies. And Google and Facebook are facing some antitrust lawsuits, which could hamper the companies going forward. Let me know down in the comments section what you think of my investments and some of the decisions I'm making. Definitely like and subscribe if you got any value out of this video. Of course, this is not financial advice. This is all for entertainment purposes. And let's get to the jelly. So today's jelly is Feeling Emo Might Delete. This is a series done by Mark Cutshall. He's done quite a few of these videos and they are pretty funny. So here's some clips from that.
What's wrong?
Nothing.
You haven't been acting like yourself.
I'm fine. I'm just a little bit stressed out.
Are you okay?
Actually, I'm not okay.
Matt, no! I am trying to have a serious conversation with you right now.
Well, if you wanted honesty, that's all you had to say.
What's wrong with you?
I never want to let you down or have you go. It's better off this way for all the dirty looks. So photograph your boyfriend up.
Do not come back! No!
It's not the life it seems.
As you can tell, he is a little bit over dramatic, and it's still pretty funny. If you want to watch the full video, it is linked in the description. Comment down below what you thought of it. Definitely like and subscribe before you go, and have a great day.